This is Bob, and he's got a huge problem. Bob didn't lose his job. His salary went up. By every official measure, he's doing fine. But every week he stands at the checkout and watches the number climb. Same cart, same store, same items, always higher. The government says inflation is under control. The headlines say the economy recovered. Bob's grocery bill is 40% higher than 5 years ago. The prices never came back down. Nobody stole anything. Wall Street Meadow just got smaller. This is the inflation story. Not the transitory version the Fed sold in 2021. Not the victory lap they keep running. The real version. How a century of monetary history built a system designed to quietly shrink Bob's hay. Who profits from that arrangement, and why the next stampede needs no invitation. Think of it like this. Every month, Bob earns hay bales. With those hay bales, he grazes in Wall Street Meadow. Groceries, rent, gas, the basics. One hay bale buys a week of food. Seems fair. Now imagine someone quietly shrinks the meadow overnight. The fences look the same. The bales look the same, but you get less grass per bale. That's inflation. Nobody broke in. Nobody stole anything. Bob's hay just buys less meadow every single year. Here's what they don't teach in school. A little of that is completely intentional. The Federal Reserve, the prize bulls of American monetary policy, actually wants prices to rise. 2% per year is the target. They call it price stability, which is a charming name for, we want your money worth slightly less every 12 months. The idea, moderate inflation keeps the economy moving, encourages spending, makes debt more manageable. Governments love it. Banks love it. The working cows? Nobody asked them. This system has been running for over 100 years. Sometimes it works. Sometimes it doesn't. And twice in the last century, it went so badly wrong that people were burning hay bales just to stay warm. To understand what's happening now, you need 3 history lessons. 1944, Bretton Woods. Every major currency tied to the dollar. Dollar tied to gold. Wall Street Meadow had a fixed size. For 2 decades it worked. 1971. Nixon ends it. The dollar's linked to gold, severed overnight. Suddenly, hay in circulation wasn't limited by anything physical. Within a decade, U.S. inflation hit 13%. It took Paul Volcker raising rates to nearly 20% to break it. The cure almost killed the patient. 2008, quantitative easing is born. Financial system collapses. The Fed buys trillions in assets to pump hay into the economy. It worked. It also established a precedent. When things go wrong, print more hay. Then, 2020. COVID wiped out the economy in weeks. The Fed doubled its balance sheet from roughly $4 trillion to nearly $9 trillion in 2 years. Congress sent trillions more in stimulus. Everyone spent it. On goods that weren't there because supply chains were broken and container ships were stacked in every port on Earth. Too many hay bales, too little meadow. The stampede was already coming. Here's where it gets worse. U.S. inflation peaked at 9.1% in June 2022, the highest since 1981. For roughly 25 consecutive months, real wages declined. Every single month. Cumulatively, prices rose over 20% in just a few years. Wages chased them, but never quite caught up. That math is exactly as bad as it sounds. While Bob's grocery bill climbed, asset holders watched their wealth explode. The S&P 500 surged. Home prices rose roughly 40% nationally in just 3 years. The prize bulls sitting on stocks and real estate got richer. The working cows renting those houses paid the higher rent. Funny how that works out. Here's the mechanic. The Fed prints hay to stimulate. Cheap money floods assets. Governments borrow and spend. Workers demand higher wages because food costs more. Employers raise prices because wages cost more. The Fed raises rates to fight the inflation it helped create. And right now, new tariffs are adding yet another layer. Companies pay them up front. Consumers absorb them later. The Yale Budget Lab estimates recent U.S. tariffs cost the average household over $1,000 per year in purchasing power. Economists call this a wage price spiral. Bob calls it the wheel that eats itself, from multiple directions at once. Once inflation expectations set in, they become inflation themselves. If Bob expects prices to jump 9% next year, he demands 9% more wage today. His employer raises prices to cover it. Everyone's acting rationally. The collective result is irrational. This happened in the 1970s. It happened again after 2020. The pattern is older than Bob. This isn't uniquely American. The Eurozone hit 10.6% in 2022. The UK hit 11.1%. Argentina, a country with decades of intimate experience with this particular wheel, saw annual inflation exceed 200% in 2023. When the world's largest meadow sneezes, every herd on Earth catches something. The stampede has no borders. In 1923, the Weimar Republic printed money to pay war reparations. By November, $1 costs 4.2 trillion marks. That's hyperinflation, a different animal from a 9% cycle. The scale is not comparable. The core mechanic is too many hay bales, too little meadow, too much trust that it won't happen here. Every generation relearns this, usually the hard way. And here's what no one says at the press conferences. When inflation returns to target, the prices don't come back down. They stay up. They just rise more slowly. The 20+% cumulative loss in purchasing power since 2020 isn't a temporary condition. It's the new Wall Street Meadow, smaller, permanent. The Federal Reserve considers this a success. They hit their target. Bob's hay never came back. And that's not a failure of the system. That's the system working exactly as designed. Let's talk consequences. For the working cows, real wages have barely moved since before the pandemic. The weekly grocery cart costs 40% more than 5 years ago. In many cities, a third of take-home pay goes to rent alone. Healthcare premiums rose over 20% in 5 years. Nearly a third of Americans dipped into savings just to cover basic monthly expenses. Total U.S. credit card debt sat at approximately $1.2 trillion as of late 2024. Delinquency rates at their highest in nearly a decade. Average interest rates around 20%. And there's a new payment category for how the lowest-earning working cows now buy groceries. Buy now, pay later. That's not satire. That's Federal Reserve data. And the prize bulls? The financial system that created the conditions for the stampede emerged largely intact. Stock markets climbed. Corporate profit margins held near record highs. Politicians stood at podiums and called it a recovery. Some economists now describe this as an E-shaped economy. The top tier of the herd thriving, the middle treading water, the bottom surviving on credit. And Bob? Bob's doing just fine, thanks for asking. The working cows? Still waiting for their hay back. Here's the thing nobody wants to say out loud. The system isn't broken. It's working exactly as designed. Central banks manage price stability, but also ensure governments can borrow cheap and economies can grow. Sometimes those goals conflict. When they do, the working cows lose purchasing power while the prize bulls hold their assets. That's not a conspiracy. That's an incentive structure. Prices don't fall when inflation cools. They just rise more slowly. Wall Street Meadow is still smaller than it was before the stampede. Delinquencies are rising. Consumer sentiment remains near historic lows. The next stampede doesn't announce itself. Not in 1923, not in 1971, not in 2008, not in 2020. The real question isn't if this matters. It's whether the meadow will ever be as big as it was, or whether we've all just quietly agreed to need less grass.